Hey everybody, this is Brant from Wolf on Wall Street Trade, and we have a market update for the first week of trading for 2020. It was a holiday shortened week. Happy New Year, by the way, to everyone. You may recall last weekend's video, gold had broken out and small caps had closed real weak on Friday, and that was kind of the theme coming into this week, and I'll touch on that. But there's really like three different dynamics this week. It was just 4 days of trading, but three completely different dynamics. One was some rotation, and that is probably due to the new year. A second one was a contradiction, basically mixed messages between what commodities were saying to me and what bonds were saying to me versus what stocks were saying. And then on Friday, we had geopolitical issues that the market was actually paying attention to them on Tuesday, but Friday it actually affected the market. Usually the market, it's kind of a flash in the pan with geopolitical issues. I usually don't pay too much attention, but the market definitely reacted to that, so we'll take a look at that. So first, let's pick up where we left off last weekend's video, which was gold breaking out, defensive safe haven asset breaking out, and small caps ending weak on Friday. So small caps actually drug the market lower on Monday when we opened. Here's Monday. So small caps weakness on Friday, even though the S&P and Dow closed basically unchanged on that Friday. Small caps were leading the market lower, and we saw that on Monday. Now, Tuesday was pretty much a consolidation day. So since small caps were leading the market, let's take a look at it from small caps perspective on intraday chart. And this is 15-minute chart of IWM. This is a December uptrend. This is how we ended the previous week, breaking that uptrend. And this is that consolidation into Tuesday over here. Remember, Wednesday was New Year's, so the market was closed on Wednesday. Here's a little closer look, and that's a 5-minute chart. So here's Monday on the open, and this hit technology really hard. And the rest of Monday, this is a consolidation, and into Tuesday, this is a consolidation. Something interesting, Tuesday about noontime, VIX got smashed out of nowhere. So here you can see VIX surge as stocks sold off Monday morning, and this is about 12:30 on Tuesday. The averages were just about flat, so this decline was really unusual activity, and I was kind of surprised that the market averages didn't do better on Tuesday, given that there was such a sell-off in volatility. But what it actually seemed to be for was, this was New Year's Eve, was for when the market opened on Thursday, the first day of the new year, and that kind of sell-off in volatility continued on Thursday. And as the market reopened Thursday, the first day after New Year's, you can see volatility got smashed, but it was a very, very bullish start in pre-market. And the reason for that was the Chinese central bank, the PBOC, had cut the reserve ratio for small banks that unlocked about $100 billion basically in stimulus that they could lend out. So the market was very, very bullish. But on Thursday morning, we had some very, very mixed signals. So let me show you the S&P first. So here's the S&P's open on Thursday morning. Okay, strong open. Now let me show you small caps. Notice what happened on their open. Really, really ugly activity. But remember, VIX was still being smashed. There were also some really mixed signals in the broader market Thursday morning before the open. First, you had index futures that were up, but also safe haven treasuries were up, gold was up, and VIX was being crushed. So what we actually saw on Thursday was rotation, and it was into large cap stocks. That includes large cap technology, the FANGs. The other sector that did really well in this kind of large cap rotation was industrials. What was interesting was nothing else was performing. So it wasn't only small caps that weren't performing, it was also S&P 500 mid caps. So as a result of this, you had a really strong day for FANGs, for the Dow, for large caps, really weak day for basically everything else, small cap through mid cap. Here's a quick look at a 5-minute NASDAQ 100 chart. So there's Monday's open, really, really ugly consolidation Tuesday. Here's Thursday. This was that large cap technology was bid up, and here's that ramp into the close. And then here's Friday. So the point I'm getting at was inside the market itself, the stock market itself, there were mixed signals in that only really large caps were doing well, particularly technology and industrials. But then everything else, small caps, mid caps, were red most of the day, even though the NASDAQ looked like this. They were actually red. Mid-caps got green in the final 3 minutes of trade on this end-of-day ramp. And at the end of this video, I'll talk a little bit more about those mixed signals between what commodities and treasuries were saying and what stocks were saying. What I always say to members is, one day is not a trend. So we did see some rotation. I think it was probably institutional rotation as the new year starts. One day does not make a trend, though. On the week, this is a weekly chart of the S&P 500. The S&P was down modestly. The Dow was down modestly. The NASDAQ was up modestly. And small caps were down. Most S&P sectors performed similar to the benchmark index in that they were pretty close to unchanged. Now, there were a few influences due to small cap weakness and that rotation, so I want to point those out real quick. Here's the material sector. It was down about 2.4%. It's a lightly weighted sector, but it is cyclical. There's the open on Thursday, gap up open, sold off hard with small caps right from the open, then sold off again Friday. That's a failed breakout. The other areas that were under pressure or coming down were defensive. So that was one of the mixed signals. So we had defensive consumer staples over here. That came down about 1.4%. And this is an interesting area for consumer staples, around 61.75. Interesting area of support. This is the 2019 uptrend. And over here you can see a really big range that it had traded in for several months. So this should be an interesting area around 61.75 if it pulls back that far. The other area under pressure was utilities. That's also defensive. It was down 0.7%. And healthcare was down 1.65%. It's a defensively oriented sector, not quite the same as the other two. And that was led by weakness in biotech, down 3%. One of the areas of strength, particularly on Thursday, and this was part of that large cap bid, was industrials. They were up a little bit over 1% on the week. And it's interesting because here is the uptrend line for the phase one trade deal, and they've been battered around at resistance over here for quite a while. So there's the breakout this week. And here's why I say one day does not make a trend, because the other sector that broke out above similar resistance was Dow Transports. And in all honesty, if industrials break out, you want to see transports break out. If the Dow 30 is up, you want to see transports up. They've also been battling resistance right here around 10,950. So let me zoom in closer to this week over here. Notice weakness early in the week with small caps and actually a little bearish consolidation here below resistance. Here is Thursday's open. So they opened strong. They sold off again in the morning with small caps. Towards the close, they were right at this resistance, and in the last couple minutes of the day, there was a big buy program. There's the breakout. So this was a pretty meaningful day for the Dow in that industrials and transports broke out. The next day was Friday, and this is now a failed breakout. Fell below this resistance, below this consolidation. That's why I say a day is not a trend. We get a perfect example here. So we have industrials that have technically broken out and Dow transports that have technically a failed breakout. And from failed breakouts come fast reversals. This price action makes a lot more sense with what is going on in small caps and even mid caps. Mentioned earlier the technology sector. This is a December uptrend. This is the start of the week. So small caps led even big technology lower. Okay, and this is one of the last sectors to usually break down, okay, because it's very popular. Here is that big move on Thursday. And remember, this is all large cap stuff. So the FANG stocks, Facebook, Apple, Amazon, Netflix, Google, those type of stocks. And then the large cap industrials. And then here's Friday. What is interesting, semiconductors did not do as well. And when you see technology break out, usually you want to see semiconductors leading. So again, here's the start of the week. Very ugly price action with small caps leading lower. Little bearish flag coming to just a little broader consolidation. Remember Monday, Tuesday consolidation. Here's Thursday with that very strong open. And by the end of the week, we're right back here around this 142.50 level. And if I back out, you can see it's been kind of an area consolidation. So this looked like a breakout with technology and then comes back down. So I know that was a mouthful. Let me just recap it for you. So we come into the week with small caps leading lower. Okay, and small caps pulled the rest of the market down Monday and Tuesday afternoon, consolidation. Thursday, very bullish market in equities before the open. Mixed signals coming from gold, copper, treasuries, and volatility was being smashed. So I had a big open. A buy program ran at the end of the day. And then Friday, this was due to Iran. As far as any rotational themes, it was defensive stocks down, large cap stocks up, and mid caps basically not doing very well, small caps not doing well, and industrials were up and technology was up. And then you saw what happened with the transports. Market breadth was very weak here on Thursday, just like it was over here. And that was due to large cap stocks leading the market. They're the most heavily weighted. They can move the averages the easiest, while everything else, or actually back here, it was small caps that weren't doing well. Over here, it was everything else, basically small caps and mid caps not doing well. So very thin, hollow breadth on this day. And what that means is you basically have a handful of very heavily weighted stocks moving the entire market while just about everything else was not participating. Now, to illustrate some of the mixed signals, yields were leading lower. So here's the S&P 500, the week over here with the 10-year yield. Notice here's that other Thursday I was talking about. Yields were leading lower here, and this is where small caps led lower into the early week. Here's Thursday, big startup for the NASDAQ and the S&P 500, while small caps were selling off, and yields followed that sell-off in small caps. That was a defensive move. Bonds bid, yields moved lower. And here, look at this on Friday. This is almost a 10 basis point drop on Friday. That is what you would call a flight to safety. So getting out of stocks into the safety of bonds due to what happened with Iran. Early in the week, I had said to members, the way that gold and copper are acting, yields should head lower. So I said that somewhere around here. And rather than go through what gold did and what copper did and what yields did, let me just show you this. This is in red, the copper to gold ratio, and then in blue, the 10-year yield. Here's the start of December. So copper to gold ratio, meaning copper is doing better than gold over here. Copper is kind of a risk asset. If you have expectations that global growth is going to pick up, copper should do better. Safe haven gold should go down. Yield should move higher. So that's what we saw early in December. And that was all about, the phase one trade deal is going to restart economic growth. Towards the end of December, though, look what copper's doing versus gold. Copper's underperforming gold. And that means that yields should come down. So here's the start of the week, and we see that yields did come down, big move over here. So it's not just this safe haven move, this 10 basis point drop, which was a safe haven move on Friday, but it's also the economic picture that copper is starting to underperform, gold is starting to outperform. And it seems like now that the trade deal's out, the market sees all of it and says, well, maybe this isn't going to restart economic growth, at least to the extent that has been priced in over the last 3 months. So this is one of those very mixed signals coming from the commodity market, the way copper and gold are trading, and coming from the bond market. These two are on the same page, or actually these three, copper, gold, and treasury yields. They're seeing risk, they're seeing weaker economic growth. And to put a fine point on it, we saw that specifically Thursday where large caps were bid, market was higher, but yields dropped with small caps. And then, of course, again here on Friday, very big move, 10 basis points. I'm not going to go too much into the geopolitical stuff, but I will say that the market was watching early in the week, around Tuesday, I think, when the U.S. Embassy was under siege in Baghdad. Usually the market doesn't pay too much attention to stuff like that. It was interesting that it did, and it seems like the leadership in Iran miscalculated. So here's a tweet from Donald Trump on December 31st. Iran will be held responsible for lives lost. He said, this is not a warning, this is a threat, and as you can see, the leadership in Iran, that guy's tweeted that we see Iran responsible for the events. Number one, you can't do anything. I think there was a little misjudgment there, and the market's worried. We might consider this a mixed signal too. This is the dollar yen, and here is the end of the prior week. Remember, small caps were leading lower. Gold was breaking out. Started to get some weakness over here. This is the start of the week when small caps and the market sold off. Remember I said on Monday afternoon, the stock market went into consolidation, and that continued Tuesday afternoon in consolidation like this. But the dollar yen continued lower. So more of a flight to safety on Tuesday as stocks were just kind of consolidating. It was showing a more risk off stance. Here's New Year's. Now remember, Thursday, the market went up, at least large caps did. NASDAQ, S&P, and the Dow, while small caps, mid caps went down. The dollar yen sold off with small caps Thursday morning. So we're getting a very risk off signal from the dollar yen, getting that from gold. You saw treasury yields plunge. And then this is another risk off signal or flight to safety over what happened with Iran on Friday. This is a risk off trend for the week. And while there's not an exact correlation with the S&P 500, this is the currency market sending a risk off signal. And I would say where the dollar yen is trading here now, it's about where the S&P was last, around 30.40, 30.50, so about 6% lower. So here's S&P futures, red and green candlesticks, and here's the dollar yen in white. Remember, I'm not saying, look, this is the pathway that the S&P is going to take, this is the target it's going to hit. I'm saying there's a huge discrepancy between what stocks are doing on the week, which is pretty much flat, weakness in small caps, and what currency markets, bond markets, and commodity markets were doing. Here's the dollar yen on the week, and here's the 10-year yield. 10 basis points on Friday alone, almost 10 basis points. So these are both giving a risk-off signal. Small caps are trading a little bit more towards this bias, but still not as bad as what we're seeing in the currency and bond market. Here's gold that I mentioned last week that it was breaking out. So it went ahead and added about another 2.5% or so, GLD anyway, to that breakout. So this was a defensive signal that we were seeing last week and that I mentioned in last week's video. And you just see it add to that. So a lot of strength here in gold, and it's kind of mirroring what we're seeing in bonds and what we're seeing in the dollar yen as well. And that's to say a more defensive, safe haven kind of risk off picture. Meanwhile, we have the CNN Fear and Greed Index here. This is as of Thursday night up here at 97. So that is even higher than last week. That's actually the highest in years. That's extreme complacency on the part of stock investors, stock traders. And like I always say, these extremes, you see where it was last year at this time when the market was selling off and then we had a big recovery in 2019. These are contrarian signals. Here it is over time. Here's that most recent reading. So you can see it's higher than anything we've seen in several years. Since we're going into 2020, I want to do just a really quick recap. Obviously, I'm not going to be able to touch on all the things that are moving the market and what's behind it, but just to give you some sense of where we are, what's been driving things, and where we may be in the next year. So this is a Trump tweet from August 19th, 2019, not too long ago. And what he says is that the Fed should reduce rates by 100 basis points. That's 4 rate cuts, 425 basis points rate cut. And says perhaps some quantitative easing as well. Here's the S&P 500 from June, where Powell said that they're open to cutting rates right here, sparking this rally. There's first rate cut. All right, here's the sell-off. This is the point of peak recession fears. Second cut, third cut. Trump asked for 100 basis points. He got 75 of those. And he also asked for some quantitative easing as well. He got $415 billion of that. I'm oversimplifying things, but it's almost as if Powell said, hey, oops, sorry about what I said in October of 2018. Sorry about this balance sheet roll-off. Sorry about those rate hikes. I'm going to kind of make it up to you. That would basically mean, sorry for what I said right here that helped cause this. I'm going to make it up to you. And that's pretty much what they've done. They've taken back 3 rate hikes by cutting 3 times, and they've taken back a lot of that balance sheet roll-off by adding $415 billion in liquidity. I mention this for 2 reasons. Both of them have something to do with what happened on Friday, and it's not the Iran thing. First, this is the point of peak recession fears. Yield curves inverting. This is the point of Phase 1 trade deal is going to rescue the economy, and the data that has been slowing globally since Q1 of 2018 and in the US since Q3 of 2018 should reaccelerate because the trade war is going to be a thing of the past. This is what the market has been pricing in for 3 months, and while they've been doing that, the Federal Reserve has added $415 billion of liquidity. I saw a really interesting chart, a correlation chart between how much the Fed had added to their balance sheet and how the S&P 500 performed on the week. So from this point, 12 weeks, not including last week over here, 12 weeks, the Fed expanded their balance sheet. Each one of those weeks, the S&P 500 gained. The 1 week the Fed balance sheet actually came down a little bit, the S&P came down. All through this time, we've been getting, especially about November, we've been getting some really ugly signals that in any other market would have sent the market lower. So part of that obviously is this Fed liquidity that has been flowing into the market. It's money pretty much out of thin air, $415 billion of it that goes to banks, that goes to hedge funds, and it makes its way into the market because it doesn't go into the economy. That is called printing reflation. Printing growth is a different thing. You can't do that. You can't print growth. What was interesting about Friday, this is a 1-minute chart, the S&P 500, here's Thursday, here's Friday, is the FOMC minutes from the last meeting came out at 2 p.m. over here. You can see there was no reaction in the market to those FOMC minutes. But within the minutes, what the Fed said was the calendar of repo operations starting in mid-January could reflect a gradual reduction in active repo operations. Remember that all of this liquidity that flowed from the Fed started with that September repo crisis. I'll put a link to the video I did at the time in September when we first saw it that very week. That crisis resulted in all this money coming in. And the big thing was that there was not enough money in the overnight lending market for these banks and hedge funds to get, and that's why repo rates spiked. That's why the Fed added all this liquidity, because the real danger was the turn of the year. That's when the most liquidity would be soaked up. That's why the Fed has increased all the repo operations and started that not QE4 over here. So we just got past that turn. Nothing happened. Now the Fed is saying that they are going to start to gradually reduce that liquidity. Remember, out of 12 weeks, the Fed added to the balance sheet 11, and out of those 12 weeks, the S&P was up 11. The only week the S&P was down was the week that the balance sheet contracted slightly, right here. So this is a theme that we'll probably be seeing in January, and it's one that might sneak up on us pretty fast. There have been so many signals in this area that in any other time would have created something like this. As a result, you have market participants extremely complacent, and that's what we're seeing here on this fear and greed index at 97. Now, the second reason I bring this up is something else that happened on Friday. Once again, remember, this is peak recession fears, okay? And we got a month of really ugly market activity until President Trump said China called, they want to make a deal, and then phase one trade deal has been made, just needs to be papered and signed, which wasn't true because it still hasn't been signed at this point. What this is the market going from peak fear to peak optimism over the economy, that the trade deal was going to turn everything around. Now, I just showed you the copper gold ratio. Over here, rising in early December, okay, looking for that economic rebound. The trade deal comes out somewhere this week over here, and what happens? Starts moving down. Basically, from the moment that trade deal came out, the CBOE skew index, the black swan index, spikes. The institutional guys, the pros, are hedging against black swan risk, basically a market crash, you could say it that way. The whole concept of hedging tail risk was born after the 1987 crash. And one of the reasons I have not bought this narrative of this economic recovery is because you can't see it in the data. And we got the ISM manufacturing index. Friday it came out and it missed expectations. Printed down here at 47. Below 50 is contraction. So we have 1, 2, 3, 4, 5 months of manufacturing in contraction or recessionary signals coming from manufacturing. This trend all through 2019, weakening into contraction, into recessionary prints over here. So if we were seeing that economic reacceleration that the market has priced in the last 3 months, you would want to see this data going like this. It hasn't been. There's no evidence for that, or very little evidence. There's some bounces in a few places, but the trend is down. So whether or not you look at economic data, it's something to watch in 2020 because the market has already priced in, fully priced in, not just, we expect it, it's priced it in as if it already happened, an economic recovery. And as you can see in this manufacturing data on Friday, it has not happened. Okay, and with that, I'm going to go ahead and wrap up this video. So into next week, it's be our first full week of trading for 2020. Volume is starting to come back in now that people are coming back from vacation. And then we had this Iran thing on Friday. So I think that's obviously going to be a point of the market's focus. We'll see what happens with that. But I think the big takeaway from the week is not just the small cap weakness, but rather the fact that you have the dollar yen going like this. You have treasury yields going like this. The way copper is trading related to gold is going like this. So the bond market, the currency market, the commodity market are all agreeing down towards this direction. Small caps are kind of leaning that way, but you have the S&P 500 and the Dow and the NASDAQ that are pretty much flat on the week. So you have a really big discrepancy there heading into next week. That will do it for this video. I know it was a little bit long. If you liked it, if you enjoyed it, please give it a thumbs up. Feel free to share it. If you have comments or questions, leave them in the comment section and I'll do my best to answer them. Don't forget to click the subscribe link down here in the lower right corner. And with that, everybody have a fantastic weekend and happy 2020 to you all.